Hi there, and welcome to one of CrossThought's first lessons. Um, Today I'm going to talk about how to build a simple mortgage calculator. The first thing you want to do is you want to open an Excel sheet and start filling in some data. So the first thing you need to know is the value of your home. Let's say it's 300,000, and then how much you're going to put down. Let's say you put down 10%, so you can say that's zero point 0.1 times the value of your home, which is 30,000. And the next thing you'll need to know is the current interest rate. Let's say that would be 4.5%. It's important to get the units right here so that you can do some correct multiplication later. You also are going to calculate a couple things. One is your HOA fee monthly, which for a house is around $50. And you will need your home insurance cost. Runs at about 0.25% of the value of your home. Which in this case is about 750. That's annual. And so you're pretty much going to come up with a monthly payment. That's your final number that you're most interested in. Let's give it a border here. Since it's a monthly payment, you say you're going to do a 30-year loan. Well, the amount you owe recalculates every time you pay monthly, so you're going to have to basically create a list of months for 30 years. So 30 times 12 months is 360 months. So you're going to have to go month 1, 2, 3, and then this should equal $0 at the very last payment, because at the last payment you have finally paid your house off. So what you do is, the first column is which month you're paying off, and the second column is how much you owe. So we'll start at month 0. You owe the full value of the home, which is, let's make a new row here for loan amount. That's the value of the home minus the down payment. So at month 0 you owe the full amount of the loan. So theoretically you could go ahead and pay that off, $270,000 at month 0. So how you calculate the amount you owe every month, you basically take what you owed before and you subtract that by your monthly payment. But you also add on interest, and your interest is basically 4.5% divided by 12, since this is an annual interest rate, and that basically adds on to what you owed last month. in this case, let's put a kind of a ghost number up. Let's say 1500. So you can see after 1 month, even though you've paid 1500 in principal and interest, you've only really put down $500 of principal in the house, and the $1,000 was in interest. So basically you go ahead and do this function here where you, oh, looks like we overpaid a little bit. We overpaid by 100,000 here. So what we're going to do here is we're going to use a function called goal seek, and that would be in the tools tab. So basically we're going to go to this last payment here and say this payment set value to 0. Basically the last payment will end us at $0 by changing the monthly payment. And we hit OK. And there we go. This is our payment. Now the other important thing to know here about owning a home is that you get a tax deduction with the amount of interest that you pay. So let's make another column here, percent interest, and your interest is going to be monthly payment minus the difference between how much your total principal on the home, or how much you owe, is. So you're going to go that minus that is basically how much principal you gained on the home. Subtract that from your monthly payment, and here you go. That's your interest in dollars. Let's turn this into a percent. So we take this whole thing and divide it by the monthly payment, and you can see the percent interest you're paying starts out very high in the beginning, and as you get closer to paying it off, it gets lower. So basically, this amount of interest that you pay on the loan gets deducted from your income. So let's say your income, what's important here is your tax bracket. So I found a better website here called taxbrackets2012.com. So let's say you're making around 80,000. So that puts you in the 25% tax bracket. So your income tax is 25%. Your annual deductible, I think that's right, annual deductible interest is 0.74, since it's 74%, times that times 12. We actually forgot something here. Property taxes, which runs at about, I think, 0.3%, so 0.013 times your home value. So this is your property taxes that you have to pay every year, and this actually gets deducted from your income as well, so you can go ahead and add that on here. So this is your annual deduction. Now what does that mean? Basically, if you multiply your income tax times your deductible interest and property taxes, money back, this is what you're going to get back every year. $4,000. Not bad, huh? Now, this is your kind of real payment here. So this includes your monthly payment, principal and interest, plus you're going to have to be putting money into escrow. for your property taxes and your homeowner's insurance. Divide that by 12. And then you're also going to have to pay your homeowners association monthly. So this is what you're going to be giving the bank every month. However, if you factor in the money that you get back, tax, we'll call it your tax break payment, then you're going to have your real payment minus this divided by 12. And that, folks, is what your mortgage breaks down to. Not bad for a $300,000 house. And you can add other things like if you have a roommate, let's say things get very bad, you want to rent out a room, and they're going to give you $500 a month. And let's say your overall cost of owning becomes this minus this. So you're only paying $970 for a $300,000 house. It's pretty good. So that, folks, is your introductory lesson on how to calculate a mortgage. You can see it's very flexible. There are a lot of things that you can do to tailor it to what you want. You can add in other fees like gardening fees or utilities, however you want to do it. Just realize that this is a very simple process, but it's very powerful. And generally when I make a calculator like this, I get accurate within a few percent of what the values actually come out to be. So I hope this helps you out. Thank you.